At some point in any business owner's life, in evaluating their business, they ask themselves, what do we do with our business? Do we give it to our kids? Do we sell it to our kids? Do we just close it down when we're ready to retire? Do we make it something more? Do we go for it and make it something more and sell to another investor? Do we sell it to an altogether third party operation where they just continue running the business as is? Do we sell it to our employees? All those questions come up at some point in a business owner's life cycle. And when that happens, the question of how do we sell it? What's the process? How do we value our business? All those questions come up. And we work with a lot of small business owners, and that's why we set this session up today to talk about that and to raise awareness about that. But I'll tell you, all of those matters take planning, especially if you're wanting to sell to third party providers, whether it's a third party owner operator or whether it is a private equity firm or another investor of some sort, and whether it is a debt facility. Any of those situations, it takes planning. There is a professional approach that should be undertaken, and the best advice is no winging it, and you can actually know what your business is worth if you take the right approach. So that's what we're here to talk about. Hello, my name is Carl Baker, and I am the owner of Baker CFO Advisory, excuse me. And you can find more about us at bakercfoadvisory.com. You can find us all over social media. I have been doing a series of webinars for a long time. You can find us on YouTube and all the social media pages. We really just like to educate clients, educate people in the market, and hoping to find topics that are relevant to you, to give you some nuggets as you're navigating through the complicated life we call business and life. So that's really why we're here. And we're going to talk about business valuations and how to navigate through that process, give you some ideas, and let's jump right in. The subject of business valuations comes up. I am not actually a certified business valuation person. Sometimes when you're navigating through a process, a seller and a buyer agree that a formal business valuation needs to be applied. And that's not always the case, but sometimes that happens. And these scenarios are very situation specific. And first time I've ever done this in all of my sessions, but I did want to just put that out there. I'm not actually a certified business valuation expert. If you needed a third party business valuation certification, I wouldn't be able to provide that, but I have been in the business a long time, and those scenarios aren't always necessary, but when they are necessary, I just wanted to put that out there. But we can certainly get a lot done and navigate through this quite effectively, even without that. All right, so let's jump in. Again, the question is, what is value? And this really sets the foundation. The age-old question that you're really addressing as you're thinking about selling your business is looking for somebody that on their side, on the buyer side, they're asking the question, do we build said business? Let's just say you're an HVAC company. And somebody else is thinking about starting an HVAC business. They're asking the question, do we build that business on our own, starting from scratch, getting customers, building a following, building systems, or do we buy this business from somebody else? And there are pros and cons to each. We're gonna talk a little bit about that today. But when that person is asking that, they're assessing if they think that it might be more effective for them to buy a business. They're going to ask about the value, and they're going to assess the value. And value does not just mean the profit of the business. There are other components to it. And this just wanted to set the groundwork on that. As I said, separating profit from value, most owners, when they're in the middle of their business life, they're looking at their profit and loss, their income statement, they're looking at their books, they're looking at their bank balance. But a buyer and an investor, as I hinted earlier, is going to look at it differently. They're wanting to understand what is it that what we're buying. High profit doesn't always mean high value, especially if that profit depends 100% on you. And that's one very common situation. When you, as an owner operator, if you are a single member owner operator, and your business shuts down, if you go on vacation, if you don't have people running the business and you're just working in the business all the time, the value of your profits and your earnings is not going to be viewed the same as if you are running a business that continues on even if you get sick, or if you go on vacation or whatever. Those two scenarios have very different values, and that's really key to understanding these for assessing value. Value is based on future potential and risks, not just past performance. And that's also very important. And current performance will, and I talk about this later, but past performance, current performance will absolutely determine value. But a buyer is going to actually look at what they think this business could be if they take over. So that's another way to say that. So when you're looking at value of the business, it really depends on there's a lot of complexity to that. But one point to bring up is, who is your target audience? Are you selling to a strategic competitor? Well, the value might be very different in that scenario, or the assessed value. Are you bringing Let's talk about that for a second. Why is that? You might need a higher price if you're selling to a competitor. They might be willing to pay a premium in order to take out a competitor. So you can see how that works. Are you bringing on an investor for a minority stake? Well, valuation could be very different there. Are you transferring to a family member or a key employee? Again, there might be some leniency there in terms of evaluation, a sale price. So understanding who that potential buyer is very important to understanding the assessed value and sale price of as a starting point. Moving past sweat equity, it's a truth, and it's very real, that if you, as an owner operator or a small partnership or a big partnership, whatever the size, your years of hard work, stress, all that sweat equity that is put into the business is not really the component. That is what you feel like is the value of the business. But buyers and investors are actually going to look for, what is it that they're buying. They don't want to have to take on a job, most likely. In certain situations, maybe one owner operator is going to leave and another owner operator is going to come in and take over. And essentially, in that case, they're buying a customer list. But if we're talking about a more common purchase or a business sale, they're looking to take over that set of processes, take over the cash flow, take over the assets, take over the customer list. They're really coming in they're buying the future profits, and because of that, in the due diligence process, the potential buyer is going to want to understand, what is it that I am buying, and from a seller's perspective, what is it that the market is willing to pay? All right, part two. So let's go into the three common methods that are used to value a business. Some of them will resonate. Some of them might be a little bit of an aha moment. But we're going to talk about what the three common methods used to determine valuation. I start with just a comment. If you're new to selling businesses, everybody is most commonly familiar with selling their house and understanding that. So one of the methods is a comparable sale method or an asset method, and we'll talk about that. That's a as you listen to this, especially if this is a new topic for you. Think about the contrast of what I'm saying about buying a business versus what you might be familiar with, which is selling your house or buying another house. So that's a very common scenario that is often compared to this scenario, and there are distinct differences in the ways businesses are valued. But that's a groundwork. So let's talk about the three methods. With method number one being the asset approach. Some businesses are very asset heavy. A construction company, a manufacturing company, a real estate company. Think about the situation of a manufacturing company and all of the real estate that is inherent in that manufacturing company. Think about the equipment that is inherent in that manufacturing company. There are assets. You might also, in a manufacturing company, you're going to have inventory in different stages. You'll have raw goods. You'll have uh, inventory that is in the middle of completion, not ready for sale yet, work in process inventory. You're going to have ready for sale inventory. And all three of those levels have different costs and different valuation scenarios. You're actually buying the balance sheet, future receivables potentially, future, you're actually buying the bank balances. So all those assets minus the liabilities, debt, what's owed to vendors, et cetera, depending on how you set up the scenario. What you would put all of that together in a purchase agreement and agree this is what we're buying and attach a value to that. That resonates with a lot of people. I think that makes a lot of sense. So method number one is the asset approach. And for businesses that are very asset heavy, again, that makes a lot of sense. For service businesses, that method is often just the floor value because there might not be a lot of physical hard assets. Excuse me. A home health agency, a service provider, um, well, let's just stick to those examples. A home health agency is not going to have a lot of equipment and hard assets. They'll have some computers and some desks, furniture. Maybe they own their building. Who knows? Excuse me. And and that might be a situation where there are a few assets, but that will generally be considered a floor. Excuse me. At some point when I talk a lot, I get a frog in my throat, and I apologize. We'll edit all this out. Um, so the asset approach doesn't work as effectively in a service business for these reasons, but uh, it's certainly looked at, and as this slide says, that's the assets minus debts are usually considered the floor of the business. All right, so let's move to the next stage then, the next method. This is this is the market approach. What other similar businesses have sold for in this industry, and this is very common. Uh, the next two are what I would say are a little more common ways of valuing businesses. So in this case, what are accounting firms being sold for these days? What are home health agencies being sold for these days? What are contractor businesses, HVAC suppliers? What are those kinds of companies being sold for? And that gives you some perspective of some sort of baseline expectation to set some expectations for what a business might be sold for. So, but you can also see how this is a good baseline, but it's not necessarily the end all because every business is unique. There are some unique things about each business, so it does make it difficult. But there is uh, some commonalities there that are used to establish the initial discussion point. Values are often expressed in both in this method and in the next method. Values are often expressed as a multiple of either revenue or earnings. So it might be something like 1.5 times revenue, annual revenues, or 3 times EBITDA. Um, and a couple comments that I want to make about that. Why is that? Why is it set that way? Well, one, the owner has built a business, and if in to go back to that build versus buy question that a buyer is asking, if you have if the buyer is thinking about building that business from scratch and not buying your business, they're going to be assessing what are the costs, how much am I going to have to invest in the business to get to where you are with your business that is for sale. How much is that going to cost? And there's some cost there. So this is one way to try to replicate that. What would you spend in order to get to where this business is today? And essentially you have to pay for that if you're buying the business. Why does a valuation look at 3 times cash flows? EBITDA is earnings before interest, taxes, depreciation, amortization. It's a wonky, nerdy accounting finance term that essentially means the net cash flow of your business. Why is it that you would pay 3 times annual cash flows or 1.5 times revenue? Well, the concept is you are at any given point, when this is the way I rationalize it. If I'm an owner, at any given point, I'm living off the value of my customer list, and that value you always have to nurture. You always have to be paying attention to. But at any given point, the value that I put in through today will last for a while. Maybe it'll last a year and a half, 3 years. The concept is, if I'm selling to a buyer, that buyer is really living off the goodwill and the work done by the seller for the last several years, and that value will last a few years. So that's why that's another way to rationalize the 3 times or the 1 times or 1.5. So just a little nugget there. Let's move on to the next method, and this is so fun to talk about because this is where you start to get into segueing into the snakes in the grass as we navigate through this. So this is the income approach, and it's similar to the market approach. And I could have put some of the notes from the last slide into this slide because they are applicable here as well. But this is the most common and important method for understanding how to buy or sell a healthy, profitable business. And the question is, how much future cash flow will this business generate for its new owner? And if it is, to go back to that previous slide, is it 3 years worth that I'm going to pay for? Is it 1.5 years worth? Is it 1 year? How much cash flow will this business generate for its new owner? And this is very important to understand. It can get very, very complicated and very situation specific, because you can imagine the buyer wants the higher dollar, the seller wants the lowest dollar. And so there is natural tension there. And that's where you have to negotiate and figure out what the truth is, and agree upon a value. But the other question is, am I buying present or future cash flows? The buyer wants the seller to pay for the hope of improved cash flows. If we're in a distressed situation, or if the buyer thinks it's a distressed situation, the seller may not think it's a distressed situation, but the buyer might think, you're making $1 million a year. I think I can get this to $2 million a year by running the business better than you, Mr. or Mrs. Seller. I think I can get this business to a higher cash flow level. Well, am I going to pay you for that hope of improved cash flows, or am I going to pay you for what cash flows you have generated or produced out of your methods and management style? And the answer generally is, in that sort of a situation, I'm not going to pay you as a buyer. I'm not going to pay you for the hope of improved cash flows. And certainly there's negotiation, but this also comes up in various borrowing scenarios. If a bank or a lender is going to give a loan to a commercial enterprise, based on the value of the business, then these sort of methods are used in those settings as well. And in that particular situation, then the question is, uh, can we can't do we base the valuation on existing cash flows or on the hope of future cash flows? I say it in terms of a lender in this example giving a bank loan. It might be to the buyer, but it would also be in a merger and acquisition scenario if they're giving financing for the purchase of this building or purchase of this business. The seller is selling to the buyer, and if a lender is giving a financing for the purchase of that, they're going to be very in tune with and interested in what that valuation is, and they're not going to be interested in valuing the business on future cash flows. They're going to be more in tune with the present cash flows and cap their financing based on what the business is currently producing. And then, of course, there's always exceptions to everything, but that's important. That's very important to understand. And I pause and I say that to help you understand just how important that is. The second thing is that I find in merger and acquisition scenarios when assessing the value, and we get into this in the future as well, but uh, it's very common for a owner, the seller, to say, well, here's my cash flows that are on the books, but wink wink, we have a lot of cash that doesn't make it into the books. I don't want to pay taxes on those things, which is illegal. It's fraud. It's not right, but it happens all the time. I don't endorse it and would tell clients that, but the reality is that happens all the time. And they might say, you're going to have that you're not only going to be buying what's on our books, you're going to be buying way more cash flow than what's on our books because we have a lot of cash, and I've just historically not run it through the cash register. You can if you want, but I haven't. But I promise you there's all kinds of cash that comes through that's not on the books. Well, good luck getting a purchase price jacked up because of that. It's just not going to happen. And certainly, if you need to finance that, no banker would be tolerant of that as well. So, what happens? That you It's a little bit cut off here, but when we talk about cash flows, we're talking about sellers' discretionary earnings. And another word that will come up all the time is normalization. So that means what are the true baseline earnings that the new business owner is going to inherit? That doesn't include financing because they can choose whether to finance the business or not. So it excludes interest expense. It excludes certain discretionary expenditures that the previous seller may have chosen to run through the business that a third party objective new owner may not choose to carry on. So there are certain discretionary costs. Owner compensation, which is really just another form of profit, that will be taken out. And when you take out all those discretionary components, and certainly there are subjective aspects of especially the discretionary earnings, that certainly gets subjective at times, and negotiation happens. But when you take all of that out, what is the objective true cash flows before you start adding owner influence? What are those cash flows? And that becomes the baseline for evaluation. And then what we don't say in here is you would take that and apply a capitalization rate, a return on interest rate, and then you get into the valuation method from that point. In all three of those methods, you take those net numbers and determine a valuation from there. All right. So enough about the approaches and the different components to that. And I'll just insert here, and we're always open for questions. Reach out at info@bakercfoadvisory.com. My phone number is on our website. It'll be on the end here. You can email me at Carl, Karl, at Baker CFO Advisory. Always open to helping people that are listening to this that want to understand any of these details better. All right. So the action plan, how do you increase your value? Obviously, you want to get as much out of it as it's worth as you can. And to go back to the different scenarios, and those numbers flex depending on who your audience is, but still, you want to understand how to increase your value. So let's talk about that for the next few slides, and navigate what you can be doing to prepare your business for success, and for an exit or financing or whatever. All right, so the key value drivers, let's just navigate through these. Clean financials, recurring revenue, turnkey processes, a strong team, low customer concentration. All right, what does that mean? So navigating through each of these. And this is why we work with business owners. If you're a sole proprietor and you plan to just close your business at the end of your business life, your career, the time you want to work, this may or may not be important. Of course, I think it's important for purposes of taxes, etc. But once you start introducing the concept of third party presentation, third party sales, then it becomes that much more important to have clean financials, reliable, accurate, timely reporting. Um, One of the common things that I see is business owners that run a lot of personal activity, or what I called in the last slide discretionary expenditures. The less of that, the less confusion or noise that's in your books, the better you'll be prepared for this exit. So I have people that I'm talking with that we're either working with or I'm hoping to work with, and one of the this is a key component of where we can add value, and or people like me, where we add value, is helping people have those clean financials for future purposes. If you're going to a bank or a lender or an investor with a bad set of books with a lot of discretionary expenditure, a lot of personal expenses, it's going to be very difficult to negotiate and navigate through that process. So we'll leave it at that. Recurring revenue. A buyer is wanting to buy your customer list, and that is the byproduct of a good customer list is recurring revenue. Do you have contracts, memberships, repeat clients? Um, I'll skip to the last point to say, do you have repeat clients, recurring revenue on a spread out basis? If you have one client, then what is it that buyer is really buying? If all you have is one client, it's more likely that they might be willing to say, I don't need to buy your business. I'll just go out and try to attract that one client as my client and steal it from you. So the lower you have in customer concentration, the more effective or the more value there will be in your business. And we put some metrics on this slide about the 15 to 20% of your revenue. The rule of thumb is you want to have lots of repeat clients. That's what a buyer is buying. Turnkey processes and procedures. It's not just that you have those processes and procedures, but you're living by them. They are memorialized. If you have turnover, then somebody coming into the business knows how to take over those processes. They don't have to figure it out. If they're buying your business at one point, you physically leave the business, somebody else comes in. Are those processes memorialized? Can the new team take over? And certainly, it's very common that most of the staff will stay, but still there is turnover, and the ownership group, the new ownership group, they don't want to figure all that out. They're buying all of the things that you've been working on for years. They're buying that, and they want it to be memorialized and as simple as possible. A strong team that can run without the owner. We've talked about that several times. Again, if you're an owner operator and you don't have processes and procedures in place, you just have a job, and that profit is really just a euphemism for your compensation. Sellers aren't interested in that. Usually they're interested in buying the business. So having a strong team that can run without the owner. And I'm not saying that no owner is ever able to sell their business. It's very common for some overlap in the new ownership group for that owner to stay on. Maybe there's some compensation. Maybe there's some some lag in the buyout, but it's very common for the owner to stay and to make sure the success of the business continues on a going concern. But generally, they want to be buying that business without that owner on a long term basis. So that's a comment there. All right. One of the last slides that we talk about in terms of the problems are what are the red flags that kill your value? And we've talked about a few of those things. Messy books, commingling personal and business expenses. It's just so important to have a good set of books to separate your personal life and your business life in preparation for this exit. Having reliable numbers, having a good set of processes that is predictable. And we talked about the other scenarios, having unrecorded transactions, cash under the table. I've heard many lenders say you can have profit, pay your taxes, and get a loan, or you can not pay your taxes by overstating your expenditures and not paying taxes on your tax return, but then you're not going to be able to sell your business. You're not going to be able to get a loan because if you're telling the IRS you're not profitable, you don't make any money, the banker is going to believe you because that's what you're telling the IRS. So they will believe you and they're going to make their underwriting and loan go no go decision based on those tax returns. So messy books, all those things are very common, and I pause and I talk about that for a while because I see it all the time. And that's where I'm trying to help business owners prepare for longer term success. Owner dependency, we've talked about that a few times. Uh, if you are the primary salesperson, lead technician, chief bottle washer, cook, and dishwasher, then if you leave the business, what is it that the buyer is actually buying? They're buying your customer list. And if you're the face of everything, what really is it that they're buying? The answer is not much, potentially. So owner dependency is something that will seriously impair the value of a business. Unstable cash flow. If you're in a business that is feast or famine, unpredictable, seasonal, then certainly that will play into the valuation method. You hear lots of people talking today about buying boring businesses, laundromats, car washes, those sort of things. Very boring, very technology independent. A lot of times owner operators have been running those, haven't put a lot of money investment into them, and a new buyer might come in and be able to influence those situations and improve them. But are they going to pay you for that future cash flow? Probably not. High turnover, constant stability systems, and that will be very important for understanding the value of your business. Complexity. What does Warren Buffett say? Warren Buffett doesn't like to buy a lot of high technology businesses. I've heard him say or read him say that he wants to be able to understand any business that he's investing in. You have to be able to understand what the business is, how you're deriving your revenues, how you're building your cash flow, how you're building your following. So complexity will if it's very difficult to understand what the business is, then that can narrow the pool of buyers. Maybe that will increase the premium if you find the right buyers, but it also could drag out the process. It could impair your value. So it's important to understand that going into the situation. Or due diligence, a buyer, investor, or investor will investigate everything. They will address all those red flags that we've been talking about. Do you have processes in place? Can you prove it? Can you prove that they are actually being followed? It's one thing for a set of processes to be saved away in your portal or in your network files or on a book on a shelf, but are they actually following those processes? And there will be a need to prove that those processes are followed. Um, Are there 3 to 5 years of clean financial statements? And that's more than just the P&L, the income statement. It's more than just your bank statements. It means, do you have a good set of books with good internal controls, a good finance team, a good set of processes? Do you have a balance sheet that is supported by the underlying data? Do you have a cash flow statement that is easy to understand? So we recommend, if you have this in mind, you can't just decide today to sell your business and then work on that and hope you have that done in the next 60 days. Usually, you need to start preparing for that. So do you have, if you're wanting to sell your business in 3 to 5 years, today is the day to start that process. Provide a checklist for your data room. If you once you're in this process, provide a checklist with in this portal. Put all of your key contracts, leases, employee agreements, your standard operating procedures, your processes and procedures, your financial statements. The common approach is to actually have a data room that people can tap into, look at, and evaluate. And then I obviously assemble your advisory team, whether that is your accounting firm, your finance department. We certainly see ourselves as an outsourced finance department for clients. So we're certainly available, but there are other firms like us uh, that we exist essentially to help businesses prepare for these scenarios. Your attorney, your banker, your business broker, all of those people should be helping you, and you should surround yourself with those people to give you the advice that you need to navigate through this complicated process. So I wrap up by just saying, the difference between, why do you do all of this? If you're really wanting to get top dollar, the difference between a professional approach and an unprofessional approach, or a wing it approach, the difference could very likely be millions of dollars. Think about, if you have no real data to give that seller or buyer, they may still buy your business. You may still be able to exit your business. You may still be able to get what you think is a very good set of a very good transaction, a very good nest egg. But if you approach it from a different, more meticulous, more professional approach, with the things that we've talked about here today, it will be the difference. I promise you, excuse me, it will be the difference between $1 and a factor of a lot more. It could be millions of dollars in difference between selling it without this preparation process versus selling it with the preparation process. You may still have a sale, but the difference will be in the actual dollar amounts that exchange hands. So that's really the reason why we talk about this, and it will pay off in the long run. So we will have on our website a white paper addressing this topic. But if you go to the bakercfo.com/guides, it's under the resources section. You'll see lots of blog articles. You'll see lots of white papers. You'll see lots of resources. We try to add some nice materials that you can take and read at your convenience. And we'll have a guide soon enough on there about this topic. We really appreciate it. This is the end of 2025, although it's a time, I don't really have to say that. It's a timeless message that will carry on well beyond 2025. We typically do this on a live basis and on the third Thursday. For the month of December, we're going to in December, pre-record a session. We know it's a busy time. We'll put it on our YouTube page, and I'll just say Merry Christmas, Happy Holidays. Enjoy time with your family. We hope you come back and watch our series at your convenience. And we're going to talk about as we segue into year end and the new year, we're going to talk about planning ahead. Does history predict the future? What you can be doing to reassess your plans, evaluating where you are in your business as we move into a new year. It's on everybody's mind, so we might as well talk about it. And we'll look forward to that, to doing that in the month of December. Thank you very much for watching. We really appreciate it. And thank you for engaging with us. You can see our phone number and email address. Don't hesitate to reach out with questions or comments. Happy to help you. And with that, we will sign off and say thank you very much. Bye-bye.